Well, someone said that to me. Like they're like, yeah, the webinars are good, but you guys, you gotta be more entertaining or something. It's like I don't know how
Okay.
entertaining this
No,
subject
like the
is, but it's like,
TikTok, I gotta stand back there and
yeah,
dance while we're
we have
talking.
to be more personalities or something. It's like, I mean, this of any, I mean, we may as well just get going. So, I mean, because we record these and so we post them live, and so after the fact, if folks show up a little bit late, they can go back in and look at it. But this of all of the webinars is the most sort of like data founded presentation. So maybe just kick it off. I'm Aaron Holm, the co-CEO of Blokable. Nelson Del Rio, co-CEO of Blokable. This is the fourth entry in our webinar series. Today we're talking about the Blokable business model and real estate economics. So how is it that innovation and modular building can actually create superior real estate returns, which is at the core and at the foundation of Blokable and at the foundation of why the product is what it is, why we look at manufacturing the way that we do, um, and why we've structured the company the way we have. So I'm going to just share the screen, and then we can get into it. Is everybody able to see the screen, Nelson?
Yep. Update.
So, a little housekeeping first. The webinar series, we're now, I don't know, third of the way into it. We're posting them on the YouTube channel as we go. So if you join late or if you want to go and do the ones that we've done previously, they're all up on our YouTube channel. If you just search for Blokable on YouTube, you can find it. And then today, obviously, we're talking about the real estate economics. Um, and at a base level, the real question is if you're able to reduce the cost of development, um, how does that create better real estate returns? Like at the core of it. And there's obviously a lot of detail to that. There's a ton of, how does the product accomplish this? How does manufacturing accomplish this? How does business structure accomplish it? And then what are the implications if you can build at lower cost? What are the implications for market rate, and what are the implications for not for profit? What are the implications for the housing market more broadly? Why is it so important to focus on the real estate economics as opposed to focusing on the unit margins at the product level? Why is this such a fundamental distinction? Everything that's been done in modular to date, prefab, modular, 3D printed, et cetera, has always focused on the product sales approach, meaning people will build in a factory, sell into development or sell into general contractors, and try to make their margins on a unit basis. And it's never worked. It's never made a difference. It's never changed the market. It's never been any different from how things are done. It's a very slim margin business to start with, and it's never made a fundamental impact. So what we're looking to unpack in our webinar today is why does focusing on the real estate economics make such a big difference? Why is it such an important distinction? How do we think about it, and how does it work? So before we go in, anything you want to preface with, Nelson?
No, I think that fundamentally, as you listen to what we're saying, and Aaron made a comment at the beginning that we're not bubbly enough. I guess we don't have bubbly personalities, but we really do if you met us in person. But the real problem with this business is it's unbelievably complex and complicated. Those are two different things. And the the history of development and the creation of wealth, it's got a machine that runs it. It's got banking, it's got developers, it's got architects, engineers, it's got inputs in the process. So when you change your view of what's being created, it changes everything, and the risks that are taken and the cost of doing it and everything else. So when we talk about development costs and returns, it comes down to kind of this big, broader picture. What are we actually doing? And Blockable doesn't create a modular unit. Blockable manufacturing wealth, and that one distinction means a whole lot, and it takes a lot to unwrap it. And you'll never get it in one, two, or three sessions, but it's a big concept.
So the first of all, we'll look at how do you get to lower costs, because this has been something that's eluded the industry broadly. I mean, typically, what modular ends up getting to is a value proposition. Traditional modular, looking at modular as a product prefab or something that's built in a factory that's sold into the process. And generally, what modular has settled on as a value proposition is that it can be faster, right? Because it's not necessarily lower cost, but time is money in development, particularly with capitalized interest on development projects. And so modular, as it's traditionally sort of thought of, is not really all that lower cost. It can be, but it's not much. And a lot of times it's looking at speed, not money. So when we look at the path to lower cost, we kind of bucket it into two areas. One is the business model is vertically integrated, which means we are the developer, which has a huge number of benefits in being able to drive down the cost of development because we control it. So we control the development process. We have our own development process. It's not like a traditional development process because we're leveraging our own technology, building system, and ability to manufacture the building. So that's one side. The business model creates efficiencies around development. And then the other side is the engineering, the product development that has led us to a building that is more efficient to build physically. Yeah. So looking at we've shown this chart before, and we kind of continue to show it because it's kind of the key, which is if you are an input into the development process, you don't have the scope or the ability to make substantial changes to cost. You can be higher quality, you can be more efficient, you can have different attributes, value propositions for the developer to purchase as a part of a project, but it's very difficult if you're in any of these boxes to make a substantial change because your incentives are very different than the developer's incentives. And so the developer who's looking to, as Nelson was saying, maximize the wealth of what they're building as opposed to, selling a product on a transactional basis. So their perspective is different than everybody who's selling them parts of the project. So this development world and paradigm is a key point to understanding how we do things and how different it is.
Yeah. I guess we could say on that map. What's the next slide again? Let's see which one's better to talk to.
How we do it.
Yeah, just go up to the upper slide for 1 second before we go to how we do it slide, because to draw the kind of distinctions here. So if you look at the developer block in the very top of this slide, and let's just say developer / owner, because ideally if you're a developer, you can own your own real estate. If you're developing for another party, it's what we call, it's developing for a fee. So they may just be pure fee based on what they're building, or they could be a merchant builder where they build it and sell it. Both of those are ordinary income activities, and they're taxed as ordinary income is just ongoing business, and they're very kind of narrow, tight margin. Everybody knows what it is. So the way you create wealth is to be the owner who creates the wealth through this development process. If you look at all the players involved in this, go off to your right where it talks about architects and project designers, engineers, down at the bottom of that. All these parties are layers of cost. And when we get to the next slide, you'll see, but just keep this slide in mind as you look at all the different pieces that have to come together to make this work, but they have to come together in different ways at different times in the process. And each one of them represents risk and money and time. So it's how you change this kind of landscape and compress it and reduce costs. We can go ahead and go to the next slide. Yeah, so it's our structure. So if you imagine this is kind of a typical, whether you have our name up there or not, it's a typical process: land acquisition, pre-development, build process, and ownership. And typically, if you're a developer and you're out looking for a site, you'll have a quick understanding of what the market is generally in terms of the rents for the building that you're building, because there's a competitive market out there. You can just ask, what are rents for Class A properties of the following finish, right? So you'll have that idea. You're going to have a rough idea of what land costs, because you'll just go look at all available land and you'll look at the closing prices. You'll understand entitlements as they currently are and what you may be able to go put together. A lot of things may require additional work and then changing in entitlements and things. So the game in development is to nail down as much risk as you can before you buy the land, understand your entitlements, know what you're going to be able to build. And the problem in all of that is that for a regular developer, unless you have what we have, what happens is you go to an architect and you look at the land and you say, hey, what can I possibly do on this parcel? So you'll do what we call a mathing. And so let's say you're doing a 5-story over a podium. You've got your setbacks, you've got your parking requirements, what type of parking you have to require in the garage, figure out all your entries and fire access and all that. and you get a rough idea without doing too much work, that costs you money because you have to pay that architect. And then you say, well, I've got a pretty good idea. Let me go out and try to get this land under contract. Before you ever close on land, the one thing you will always do is find out, hey, is there contamination in soils? What are the soils conditions like? I'm going to have to, do I have a water table that's 6 foot that's going to change how I put my foundations in? So there's all these things that you want to test for and understand before you have to go pay for the building of the thing, because everything in that soil represents dollars of some type. So every step of that process requires a better understanding of the product, how it applies to the site, and more certainty requires expenditure of more dollars. And so it takes more time, more dollars, more risk. And then when you finally get to the point where you say, wow, I've got this kind of rough idea of what I can build. I understand the risk of the site. I know what it's going to cost me to build because I've done this so many times. I understand the market. You wing it and say, well, they try to get my entitlements. And if you're lucky, you have a contract that lets you stretch out the purchase until the time you get the entitlements. So you go push on that. You got to spend money for that work. That means you got to get design work done. So now you hire the architects, engineers, go do more work. So now you're going through all this and you may lose because you don't get your entitlements, or the landowner may say, I'm tired of waiting, you got to close. And as you go through all this, if you can't get rid of all the risk, then you're taking risk and sucking it up and holding dirt if you don't get it right. Let's say you spend all that money and then you get to the closing of the dirt, and then you're saying, whoa, I still don't have a plan set that I can build. Got to go back to your architect and say, you know, that thing that we said we can do, now we have to go do working drawings. That's the thing that lets us go out and get a contract with a general contractor. That's more money and more time. So you've got all this big, long, drawn out period where you're still not certain what everything's going to cost you. And then once you have a set that's strong enough, you go out and start pricing it with your contractors. So to go from the first step on that very first day when you drive up to the lot and look at the dirt to the day where you're signing a contract with a general contractor, that's a lot of risk, a lot of time, a lot of cost, a lot of work. And what Blokable does is say, wait a second, if we have a process for building, it's land agnostic. So it doesn't matter what the soils conditions are. It doesn't matter what the earthquake requirements are. It doesn't matter how you design the building and how you have to articulate the facade because we're trying to make it fit into the neighborhood. It doesn't matter what type of skin we put on. It doesn't matter what type of roof we put on. None of this matters because we have a stable system that can be manufactured. What that means is the day we look at the land, by the next day, we know it can be built there and we know what it's going to cost to build there. We won't know for certain what the soils are doing. We won't know foundations perfectly, but we know what our building can go on or what it would cost to put on the various foundation types. So we have this kind of range of costs that we can hit. So before we take all that long, drawn out, high costly, high risk, uncertain path, we can bring it on day one and then make a quick decision. Hey, we can move forward. We can talk to the city. We know it can be built. And let's see if this risk is worth taking on the soil studies we would do. So we can cut through all the red tape, move really, really fast through it all. And I know it doesn't sound like a lot, but the ability to compress that time is worth a lot of money. Getting rid of all the soft costs, you'll see right there in the land acquisition pre-development. As you squeeze that time down, the real certainty, it isn't just that we squeeze the period from 42 to 54 to 24 to 33, or you can even do it faster. It's that we reduce the cost and we reduce the risk, and we had certainty up front. The pre-development in the yellow line before, number 1 and number 2 areas, that period is a lot of risk and a lot of money. And I personally, I'm a developer. I have over 1 million square foot, half in not-for-profit and half in for-profit. And I can tell you, I've been in that 24-month period and got my tail kicked because the tests weren't right and the cost didn't come out right. And what you do is you say, I'm going to pull out, and to live to fight another day, I'm not going to waste any more money because that's a bad place to build. So we want to kind of cut that off early. We want to know our risk. And the other thing that's really kind of unusual, that's even more apparent now, is when you're in a period when costs are escalating and there's a lot of uncertainty in the market, the closer you can get to buying your materials to when you close on the land, the less pricing risk there is when you're on your product and on your contract. So if you take down land, then you got monster pre-development construction lineups and you get your GMAX contracts, who knows what happens to the price of steel or wood or anything else over 24 months. So now you got a whole lot of pricing risk. So the beautiful thing about Blokable is it gives us this pre-engineered, pre-architected thing that is highly changeable and variable, but highly standardized for manufacturing. and that certainty makes it much more efficient in terms of cost and time and application to a site, and makes the ultimate ownership of it better, because we know the capital stack, we know the return, and we can limit the risk on the day we lock things in. Anyway, Aaron, that's a
Yeah,
short
no,
version of it.
it's always a short version. So just looking at some of the highlights on the real estate economics, I mean, we hit on them, some of them already, but just the ability to build at lower cost in a shorter time frame with less risk. I mean, from a developer's point of view, that is the ultimate solution. If you can accomplish those things, then you fundamentally change the game of development. But we also build buildings that are more efficient to operate and more efficient to run, which means we can generate a higher NOI. We have lower maintenance costs. We can get better insurance. We can get all kinds of benefits because of the predictability and the quality of the system and how well it performs from an energy and a long-term useful life perspective. So that gives us an advantage in terms of the thing that we own in the market when it's there. We also have the ability to build highly valuable real estate. So modular has a bit of a reputation because of how it's been conceived of previously as being, not very architecturally flexible, not really able to meet the market when it comes to different floor plans, not being able to create amenities, lots of light. Like our view is we're looking to compete in markets based on rental rates, right? So looking at high rent markets, what are the renters looking for in those markets? And they're looking for open floor plans. They're looking for lots of light. They're looking for pools and rooftop decks, and they're looking for things that typically in a site build, everything costs money. But from a modular perspective, most modular systems just can't accomplish that. They're not able to deliver those types of features. So because we've been engineering our building system from the beginning, from the perspective of development wealth creation, that's where we focused on some of the features and the capabilities so that we can command those types of rents.
Aaron, I would add it's important as part of the development process. And again, this is complicated stuff. You can go back and watch the other um, videos. But when you can design something that doesn't have shear wall on the window line and on the door line, it means you can change your entries. You can have all glass, like these are. You can have big sliding doors. You can change this living environment, 9-foot ceilings. All these things allow you to compete in the high, Class A, $5-6 square foot markets where they expect only the best. And modular is not known for that because of the way it's built. And to build a wood frame modular, you're going to have shear wall on the window lines. You'll have much smaller window spaces. It just doesn't have the flexibility. And you start creating those facades. If you look at that building, those aren't artificial articulations in the building frontage. Those are physical changes in the building that make the building look better, make it operate better. It gives us the balcony space. It's something you would build on site normally. Modular has a very, very hard time doing that if you have to do it new every single time. It's very expensive and it's hard to accomplish with just traditional builds.
Or if you're not building with steel as well.
Yeah, still, yeah. Without wood. I mean, I know there's been a whole lot of talk about how green wood is, and go cut down a tree. I'm not sure how green that is. And there's also great science behind the first 20 years of the tree growing. It puts out carbon, it doesn't take it in. So it's not a great outcome. And I did notice, Aaron, I was driving back from Sacramento from the office yesterday, and there are just rows and rows and rows of dead trees lying everywhere. And I was just thinking about the carbon going into the air as it breaks down. So wood is turning out not to be a great life cycle analysis kind of outcome for most people. So steel is becoming the green option, especially now that steel manufacturing is going very green. So it is the best way to accomplish what we need to in the ESG environment.
Yeah. So then looking at, we've shown this, and we might sort of cut it off if we want to, but one of the keys to driving down cost, right, is leveraging the building system so that we can use manufacturing as a way to build, taking as much of the build off of the site as possible, moving it from a construction process into a manufacturing process. And that's one thing that's the last 6 years has been a heavy investment in making sure that we're able to manufacture a building system that can command the highest value in the marketplace as real estate. So, the ability to manufacture is a key attribute of that. But then the question is like, what are you manufacturing into, right? So we could, the thing about real estate that everybody misses, and we've seen this with other companies. You see this with companies that are out there, raising money and trying to put things through a manufacturing line. But at the end of the day, if you're manufacturing something that's going to be real estate, it has to be, it has to have value as real estate, right? So from a development perspective, I mean, you could manufacture wood boxes, and this has been sort of the state of the art of the industry. Most modular is making walls, making floors, automating different elements of the build. So creating walls or creating boxes, and those boxes on their own aren't real estate. They can't become sort of high value real estate. So the value of reducing the cost, you're talking about a commodity input. So there's not a lot of upside to bringing the cost down another dollar or $2 for us. The ability to use manufacturing is one part of a more comprehensive picture, which we'll get into after, which is if we can substantially reduce the time and cost and risk of building real estate, like high value real estate, that's how you solve the problem of housing. Because once you've reduced the cost, it gives you the ability to address both the market rate problem, which is how do you make a lot of money by being a more efficient developer, but also addressing the affordable problem, which is how do you drive down the cost and create the opportunities for ownership.
Aaron, back up that video 1 second to the three
I'm not sure
bedroom.
if it'll back up. It's sort of
Oh
like,
no.
yeah.
Okay.
Yeah.
We can go back to it again and speed up. Yeah. So as you look at the video, what you're going to see are variations in floor layout. But what I wanted to point out, if you look at the represented columns, you'll see those kind of square dots are the columns in the building. That is the only structural limitation we have. There are no load bearing walls in our build, which means when you see those front rooms, they're broken up to make here's a front room space, here's a living room space, here's our dining room space, or here's a 1 bedroom, 2 bedroom, 3 bedrooms. As you break all these things up, imagine if someone said, hey, I want to have 30 feet of open window line. I want a whole different living environment. So our build lets us do any of that. Just because the only thing structural for us is those little square columns you see in the floor plan. Everything else can move, and we could open the whole thing up to probably 30 feet plus with one column in the way. So imagine the flexibility of that system. So it really makes kind of the architectural flexibility of the thing and the livability of the thing kind of easy to work with, and it makes the manufacturing of it easier. It also makes the application of it easier. You see the different types of builds, but also, is it for senior living? Is it for regular market rate housing? Is it co-living? Is it student housing? Is it hospitality? Each one has a different build to it, but this flexibility in the structural system and engineering allows that to come from the very same design.
And then we've touched on this in some of the other webinars, so we won't go too far into it, but also the ability to take that manufacturing and leverage it into larger building systems is a key point as well, because it gives us, again, the ability to create the highest value real estate in the market. So then, looking at the ownership benefits, we won't get into the details on this, but it'll be posted on the YouTube channel if you want to get into the details. But there's a lot of benefit relative to traditional wood frame, traditional wood modular. If you look at the capabilities, the performance, the energy efficiency, the level of quality that we're building to, it creates a lot of advantages for ongoing ownership and operations. And when we get to looking at the specific economics of how Blokable creates cash flow, that becomes very important because of the cost basis relative to the quality and the performance of how it's valued in the marketplace. Obviously, creates a lot of cash. So over time, if you look at the benefits of vertical integration and the way we think about reducing costs, we think of the costs very much in the way that a developer looks at the costs of a project, right? So the land cost, hard cost, soft cost, and financing cost. And because we can make a substantial impact on 3 out of those 4. We can't do much about land costs. We can pay more for land if we're able to build at lower cost, which is an advantage. But other than that, between the soft cost, which Nelson was mentioning, and all the pre-development and all the activities that we do on the development side, the soft costs, the financing costs, and the hard costs are all areas that we can make substantial reductions.
I would add, though, Aaron, so the ability to design a site and understand what it can be used for and do it fast and know our costs means we can close faster on dirt and have much more certainty, which makes us much more competitive. So someone could offer more money for a site than we would, but that person could say, hey, you know what, we're going to put a deposit down. We want it refundable. We want X number of months to go out and do this and work through entitlements. And we can look at it and say, we understand entitlements. We can build to code right now. It's all entitled. We think we understand our costs. We have already talked to the city. So we may be 5% less, but we'll give you money in 2 months, 3 months. Let us get through soils tests and we close. So there's advantages to having certainty in our model. It gives us the flexibility to act a lot quicker.
So then looking what that means, looking at what that looks like in a specific market, and these costs are already coming forward. We've already seen some of these numbers that we had projected out to 29, 2030 are happening now. There's a big pullback that's happened in development over the last 6-8 months, particularly as interest rates have changed. But our ability to look at a cost, traditional pro forma, traditional cost basis on a per unit all in total development cost, and put that on a downward arc instead of the just endless inflation which is happening in the market otherwise. This is the answer. The ability to push this number down, which is fully possible and fully available to us because of all the work and investment that we've made to now. Business model, building system innovation, building system engineering, manufacturing prototyping. All of that work means we know our costs. And so we know where we are and we know where the cost reductions come from. And even from a conservative basis, these numbers are already higher. And these numbers, we believe we can push them lower with additional efficiency. So if you look at this gap between the two, that's where the wealth comes from. That's where the money comes from. It's in between these two lines. So the superior returns come out of the core structure, right? So the business model, because this is not the way traditional modular is structured. Traditional modular is here, right? This is a traditional modular factory. They're at the factory level. Our company is structured, in this way, which allows us to think about the efficiencies that come out of manufacturing and out of a faster build, just as one example, but also the efficiencies that come out of vertically integrated development. And then how do you leverage them in a tax advantaged way to create the maximum amount of free cash on the market rate side, but then also the ability to think of things entirely differently on the not-for-profit side?
Yeah, I think if you look at the company structure, done this before. I created this for commercial decades ago, created the first design build finance operate managed structures, P3s on Wall Street, lowered the price by 40%, cut the time from 5 years to 2.5 years to build large commercial projects, and went from tilt-up concrete to steel moment frame and granite. So huge increase in quality, but it was all because took and streamlined that kind of relationship between the architects, engineers, development process, contractors, just everything, squeeze all the excesses out, which we've applied to this model. Then we went a step further and said, well, if we control that design and engineering so that every time isn't brand new in terms of the process, that means that, well, it sounds obvious, but supply chain stability is really important. And to know that the base engineering allows us to order everything and always be usable regardless of the design, that means we can get a very stable kind of input process, and the output becomes faster and faster since the building looks different, but the manufacturing is the same. But the real key to it is we keep the project level risk at the project level. And so a lot of people talk about propco opco structures. You can go read papers on it, but so far any paper I've read has been done by people who really don't know what they're talking about in propco opco at depth. The real question is, how do you possibly create an opco structure whose business is to manufacture wealth? And in our particular structure, we transfer those blocks. As you see the arrows, they cross the line over the GMAX contractor, and then they get put into the project. We do not want to be GMAX contractors. We don't want to have the weight it takes to become a contractor in different locations. That's not smart. What you become is the thing that manufactures the input they use to apply with our drawings and our guidelines for applying it. So we take the risk out of it and get rid of the contingencies and all the extra costs they typically build into it. So this to make everything much, much tighter, but it's also to say to our investors in the company and to each project has to underwrite on its own. So we know what it costs, we know what it takes, and if it can't support itself on the rents that are available, you shouldn't be building it. So that's kind of the fundamental idea: is you remove the company from the property level risks and have a separate LLC every time doing it. But the real key is the Blokable LLC side on the left builds it at cost. the way it makes its money is to own the residual value on the right. And by doing that, that means you didn't have an intervening taxable transaction. You didn't sell, you didn't go out and say, I'm going to build something for a margin on something and give the profit to the developer. We use the decreased cost to kind of enable a much better capital stack into financing. And then in the takeout financing is where you get your money back. And then in the ongoing ownership of the asset, both of those of which, and when you own real estate, it's passive income and it's sheltered by depreciation on the asset. And then when this thing is sold, if you do sell it in the future, it's now capital gains instead of ordinary income. So all these big changes have monster impact on how the cash flows back and forth and the net profits.
Yeah, and this breaks it down. This lovely table kind of breaks it down to how do you think about um, the different streams of cash that come through if you're leveraging the modular build into real estate ownership, as opposed to thinking of the block and then selling it to a developer. So this model is essentially this is the 29x model, which says, if once you've stabilized the manufacturing process, you're not trying to make your margin on the product sale to the developer. And here we've generously put in a 15% assumption. And so, most modular builders are looking to make 10 to 15% on their projects when selling it to a developer. And they use the 10 to 15% typically as a way to keep the lights on for the next project. So there's not a lot of room to sort of reinvest, to continue to innovate, to incentivize cost reduction. I mean, they're not going to sell the projects at lower cost. There's no incentive to sell the project at lower cost. They're going to try to make as much as they can based on who they're competing with to get that developer dollar in the first place. But if you look at where the money comes from, this is really the key over here is what are the proceeds? Where does the cash come from when we look at profits over a 10-year period, let's say? We take that block and instead of selling it and not owning anything and just moving on to the next project and then trying to make more margin, instead, that block is now real estate. That block then becomes a key aspect of a project that we've built. And as such, it's entitled to different streams of incoming cash that if you have a lower cost basis, materially change how you would think about the idea of profits.
Yeah, Aaron, let's add to that because people wouldn't necessarily see it here. When you're a modular manufacturer and you're selling to the developer, and I'll speak to you right now as a developer for a minute, but take off my Blokable hat. I will never pay the highest bidder on a project. My goal when I have something to build is to go out and find the lowest bidder on the project. And I don't care how long they've been talking to me. I don't care how much help they put in. If they come in and they're 10, 20% higher than the person who bid it on the same exact specs, the lowest bidder wins. And the nature of modular is that given a developer goes out and works on designing something in pre-development with architects and engineers, and then they mass it, the contractor will look at aligning themselves with a modular person if they're going to plan on using modular, but they won't sign a contract for it because they can't. They do not have the money for it. They don't have the plans for it. And if they sign a contract to take it as a certainty, that means they're going to get sued if they don't close the deal. So that will never happen. So what happens is the modular is sitting there going, I have an order, I have an order, I have an order, I have an order. A year goes by, year and a half, 2 years goes by, I have an order. And then right before the order is done, the developer says, that order we were talking about, we have somebody right down the street that's going to do it for 40 bucks a square foot less. Sorry, I love you. You're a great person. Let's talk about the next one. That is the history of modular. They get their tails kicked. And what it is, it causes the entire industry to compress to this 10% margin, 15, Aaron's being very generous. The studies we've seen says at a perfectly structured partnership model that everybody's stabilizing, they'd be lucky they get to 10. And so what it does is as you go through real estate cycles, the company involved in that process just gets destroyed. So it's been, I don't know how many cycles where this has happened. It's going to happen again. I think modular is probably the worst investment you would ever want to make in real estate unless you own the real estate as an outcome. That's the only way you should be doing it.
So this sort of outlines again, like on a per unit basis, how would the profits compare? And I think the key is this word here, which is additional profit. And if you look at the number, it's just like you're not even talking about the same. This is where modular as a concept just falls apart. Like the modular development and modular construction have very little to do with each other. They don't work the same way. It's not the same business. The only thing they have in common is the word modular. And I think, there's a lot of history that you can point to that can show that the traditional modular approach is very predictable in terms of what happens in market cycles.
Aaron, I would add something because you want to point that out, modular development. So modular development itself, to be a modular developer and have a stable product, it means the thing had to have been engineered to be flexible enough to go everywhere and do anything. And the fact is, most modular, because of its, and especially in California, let's put other places out right now. California has high seismic requirements. Those seismic requirements require a lot of structural and shear wall and bracing, everything else. That kind of changing of the building all the time and engineering for the site specific application makes it very difficult, very costly, and hard to standardize in terms of advanced manufacturing. That is the failure point. You can't get to it. You can't be fast enough. And no one would have any reason to know this, but in the state of California, if we have a project we're building, when we file for the permit to do the modular for that site, it actually has to be for the address that it's approved because they know it applies to that address. So you couldn't go out and just build, 400 or 500 blocks and let's go drop it in address X. It literally has to be built for the address. And so that means it's very site specific and you've got to engineer for it. And you have to have a product then that is flexible enough to do anything anywhere. That's what we call our design land agnostic.
So then if you think strategically about that point, so that also leads along with other sort of demographic and economic factors. California is very expensive to build. But California is also home to 6 of the 10 most expensive rental markets in the country. So you have an expensive market to build for, but you also have high rents. So for us, starting in that location is key because it means that we've solved the difficult aspects of the build from a regulatory and a cost perspective at a level that can be supported because of the high rental costs. So it's a place where we can underwrite the real estate despite the fact that we're still making our way down the cost curve as we continue to generate efficiencies, continue to increase volume, and continue to simplify the process. But if you look at what that means over time, it means relative. So currently we're up here, we're looking at time and market costs. And then if you look very quickly, we're able to get substantially below the projected market cost to build in pretty much every primary market in the country. Now, this is looking at podium builds. So this is looking at sort of 5 over a podium build, which is a particular type of build. It's the most sort of dominant multifamily building type, particularly in the West Coast and in tier 1 markets. It's not the cheapest build. I'll get to that one next. But if you look at our ability to get below current and projected market costs in every market, talking about Texas, East Coast, Southeast, all these markets, we get substantially below market costs, which means we can choose. We can decide how much development we want to do, which markets we want to be in, because we have the ability to be below market cost in any market we choose across the US. So I'll get to this one next, which is even beyond the podium build, even if you get to suburban garden builds, which are typically wooden, wood walk up, this is the cheapest stuff that you can build. Typically, if you were to build in Texas or in the Southeast, I mean, this is considered sort of the cheapest multifamily that's built across the country. Even in those conditions, we get substantially below market cost. So as the cost reduction starts to kick in, it has an impact, obviously, on the market application that we're building for, which is the sort of a podium build. But then all the way even down to the most basic wooden walk-up garden style, typically wood, which is the cheapest construction that's done in the U.S. So across the board, I'm not going to sort of pause on this for too long because I do want to get into the not-for-profit side of it as well. But these are the points that we've touched on before. Just the ability, like if you can build as a developer, if you can control your process, reduce your cost, and do that in a way that functions across market types, it changes the entire industry and it changes housing forever. Because if you can build repeatedly a higher quality, higher performance product at lower cost, in any market across the US for even the cheapest type of build, which is the suburban, wooden walk-up garden style apartment, you can change housing forever. That's all on the market rate side. So that's a segue into the next part of it, which is there's two markets in housing. You have the market rate housing, which is how you make the money and make sure that you can continue to incentivize your engineering and continuing to drive down your costs. But we started this company from the beginning to address the full scope of housing, and to really get underneath the difficult aspect of affordable housing. Because if you look at affordable housing, developers have an even more complex problem, which is not only do they have to build in the market, so they have the same costs as every other developer. They have to go out and get things priced. They have to go through all the steps that Nelson was mentioning. They have the same prices, and they have to manage low income tax credits. And so by having to manage the low income tax credits, that's a whole other layer of burden. So typically what you'll see in most markets is that it's more expensive to develop affordable housing than it is to develop market rate housing. And a lot of that comes back to the added layer of bureaucratic burden that goes on top of affordable housing.
Don't forget also prevailing wage and everything else too. That's a whole other layer.
So Nelson, maybe you want to talk to the sort of overall the affordable to own structure. These are some of the aspects of it that we're looking to completely change the paradigm for what's quote unquote called affordable housing. And to do that, it changes the role of government, it changes the role of developers, it changes the role of the entire industry. But this is, Nelson, this is an area that I know you've got close to your heart.
My life, man. Yeah. So I'll give you a very kind of brief explanation of it here. This is a subject that could take weeks and multiple books to explain. But the real question, this kind of goes back to the very opening remarks. What's the goal of Blokable? Blokable is a manufacturing process to create wealth, not to create modular units. That means that everything you do should streamline the process of wealth creation, squeeze out all those things that are variables that add risk, and that extract wealth from the process as you're doing it. So you create the perfect kind of money-making machine. If you do it right, you lower your cost, you get to the point where you build real estate without equity. Why? Because if you lower your costs enough, you can use what we call mezzanine financing and other forms of debt to replace your equity, and then you're just building profit out of nothing, just debt, which is a wonderful place to be in. However, when you look at affordable, and this kind of, it's more who we are, and it doesn't have to be this way, but it's the reason for building the company the way it is, the reason for the structure. The affordable market does compete with in our version of modular development, because we would never rent to people who couldn't afford to rent. They couldn't afford to pay $5 in the coast in Santa Monica. They couldn't afford to pay top dollars in La Jolla, San Diego, or other places. And so there's nobody servicing those people. So the real question is, how do you deal with a split market problem that exists? Our answer is not to go out and to feed the funnel of people who intend to make money off of the underserved or take advantage of the system. We said, well, look, since the affordable use is really non-competitive in our underlying business because we don't make profit off of it, we shouldn't be, then you can easily have something that doesn't cost you to build. So you build it at cost and have a small margin for R&D, because you have to just stabilize the company and always go forward. But the goal is to manufacture a system that over time can stabilize itself and operate on its own as a not-for-profit. And it doesn't cost the shareholders a dime. And essentially, instead of having people tell you they're a B Corp, or we're donating money, or we're going to have a few affordable doors, we look at it, and I've done this before, so this isn't a made-up model. You ask yourself, is there a way to create what we would call a public good? Because providing housing for the underserved, providing housing for people who could never afford to buy a home in Los Angeles, San Francisco, one of these major markets, is something that changes society. And it essentially, to us, is a public good. So to get to that, it's too complicated to go in here. We can have another call on it, but we can implement a number of tax exempt structures that use tax exempt financing to assist people in buying. We can use tax exempt zero coupon carrybacks in our financing structures. So we carry back paper and issue debt. We can do a lot of things to squeeze the cost of the building down. So the chart you're seeing here at the bottom line, we can get our costs down because we apply these different tax exempt tools and financing structures and deferred financing, and not in a way like if you had seen anybody who has, I think Divvy or some of the others who have home sharing programs that put down payments and find ways to get money back and things. Those are really nice, and they think they're doing the right thing. The problem with it is anything that costs the buyer who's underserved and having a hard time in the first place, if it costs them equity and squeezes them on rate later, bad idea. So we look at it and say, how do we support the acquisition of real estate, given we control the creation of the wealth, using the tax exempt tools that exist in the world, and then don't have to create something new, just apply it in a different way for these people to own all the wealth generation that takes place over the next 30 years in that building. So if we can get our costs down on this curve that you see, the regular builds, apply the tax exempt tools to that build, and all of a sudden we can put homes into people's hands in markets that should be near $1 million at 250. Now imagine what that does for government policy. Imagine what it does for taxation on the community. Imagine what it does for community development and education, health, welfare, that just what it does for changing the society. So for us, the key was the creating that lowering cost of on that gray line where it says blockable build market rate. That is directly translates to lower and lower cost for the underserved in our society. And we want to demand get away from the costly approach to light tech, get away from the costly approach to doing this market where it's always competitive interest. The people who are building for the market rate are building for the affordable, and they always drive that price up. And I will guarantee you, we're not showing the curve here, but if you were to go out to 2030 and ask what it's going to cost to build affordable, it's going to be right up there by traditional and over it because it costs more to build. So imagine the burden on the community, the amount of homelessness and everything else. So Blokable, personally, I've done this. I've built over 165 million in cost. I think it was. We've given away the present value, I think, and when the debt's paid off in about 8 years, 100 or $300 million in real estate in not-for-profits have given away. So this isn't a theory. I've done it in commercial. At scale, it can be done for housing for the underserved across this entire country. So if you think about investing, I think, and I've been in space a long time, it is the only investment in the world that allows you to make profit as a, let's call it our black hat side, where we're market rate builders are making money because that's our goal. How do you maximize yield on our investments and make a lot of money doing it, while at the same time doing something that doesn't cost our investors or us, because it would never be an open market for us, and we go out and change society as a whole. I mean, it's the dream that everybody thinks they're going to get to and never has. It's every year at WEF and all the other big discussions change capitalism and economics, but nobody ever does it. It's ESG. And we don't believe in making better, cleaner, faster, bluer, perfect, all electric. You know, all these things are really nice. And who's going to pay for it? What's going to happen when a home costs $1 million? Tell me how many people can afford that and still go work at Chipotle as a checkout person, or go be a nurse in a hospital. They don't make enough money to buy that $1 million home. So that's really kind of that's the heart of what we do at Blokable, is to use this thing and create a solution using kind of advanced manufacturing and technology to create massive wealth while creating an unbelievable solution for the public good at no cost to our shareholders. So I know that that's kind of a big, broad paintbrush of it, but big picture.
So with that, let's open it up to some questions. And so if there's any questions that people want to put into the Q&A, now's the time. We've got a few minutes left for questions, and we can answer them. Otherwise, we'll wrap it up and we can post this to YouTube, and we'll send out a note to everybody so they know where to find it. So if there's any questions, please put them into the Q&A.
We were easy to understand today.
Yeah.
I thought we are not easy to understand. They kept thinking what the question is.
It's either far too complicated or far too easy to understand. Yeah, either way. All right. Well, with that, if there's no questions, we're going to drop off and thank everybody for your time. We'll post this to YouTube and we'll send out a notification, and have a beautiful day. Thank you. Bye-bye.